is Apple? Your first response might be something along the lines of a tech company. After all, it makes phones, laptops, smartwatches, and even its own chips. But dig a little deeper, and you might have to add services to that list too. Think iCloud, AppleCare, etc. But what about a bank? Recently, Apple has been doing more and more bank-like activities. The question being, is calling Apple a bank a step too far? Now, just last month, Apple launched a high-interest savings account in partnership with the investment bank Goldman Sachs. Paying 4.15% a year, the account offers depositors more than 10 times the average US savings rate and trumps the offerings of competitors, even Goldman Sachs' own offering. But this isn't Apple's first rodeo into the financial services area. Back in 2014, they launched Apple Pay, their mobile payment service, allowing users to make contactless NFC payments with their iPhone. Things then stepped up a gear yet again in 2019 when the company launched Apple Card, a no-fee credit card created by Apple and powered by iPhone. Now, that might be true, but the card was actually issued by, you guessed it, Goldman Sachs. And this link runs so tightly that you need to have an Apple Card in order to access the aforementioned Apple Savings account. So, with that in place, Apple has a savings account and a credit card. Kind of already sounds like a bank, doesn't it? Well, not quite yet at least. That's because both Apple's savings account and credit card are offered in partnership with Goldman Sachs. That means that the risk here is nominally being taken up by Goldman Sachs, with them, not Apple, ultimately handling the financial services end of this deal. So, what actually suggests that Apple is prepared to encroach on the banking sector isn't their card nor their savings account, but instead their buy now, pay later scheme, known as Apple Pay Later. Now, buy now, pay later schemes are nothing new, not even for Apple. In the UK, for instance, Apple themselves have been offering a finance plan for their products for a while now, in partnership with the high street bank Barclays. But what's different about Apple's Pay Later scheme is that it's in-house. Instead of relying on a major bank like Barclays, Apple is the one doing the lending themselves. Apple are the ones putting up the cash. Something it, to be fair, has a lot of. Now, as we covered on the channel before, Apple is rich, and by that we mean cash rich. While Apple, like most tech giants, has a truly astronomical valuation in excess of $2.7 trillion, what sets them apart from the others is their bank balance. Even after a rough few months for the tech industry, according to Apple's latest SEC filings, they have about $16.55 billion of cash equivalents, and securities, of which $17 billion is held as pure cash. Now, while that's down from the lofty heights of 2018, when they had about $237 billion on hand, it's still, without a doubt, a hell of a lot of money for any company to have readily on hand. That amount of cash, the work to move more and more financial services in-house in a project dubbed Breakout, and the fact that Apple generated more profit from its services divisions last year alone than JP Morgan Chase and Citigroup combined, all begin to come together to make a compelling argument that Apple is a potential threat to the big banks. In fact, according to some, Apple is already a bank. Jamie Dimon, chair and chief executive of JP Morgan Chase since 2005, stressed that it might not have insured deposits, but it's a bank. If you move money, hold money, manage money, lend money, that's a bank. Fear among banking elites of Apple's rise isn't just limited to one individual or even one bank, though. The chief executive of American Express, one of the world's most valuable companies, has said that he's paranoid about Apple and Amazon's intrusion on the banking spaces, given that both companies have deep links to consumers. With him remarking, "We're not naive enough to think that we can just go on strolling down the street here. We think everybody is coming after us." Now, according to 3 former Apple employees talking to the Financial Times, Apple is trying to play the long game here and wants to organically take a bigger and bigger bite out of the banking world. Apple has been, according to the same FT report, working for years on allowing people to not only pay using their iPhone, successfully achieved through Apple Pay, but also be paid. Something is already, albeit quietly, launched in the United States. That's because Tap to Pay on iPhone allows merchants, i.e. businesses of all sizes, to, quote, use their iPhones to seamlessly and securely accept Apple Pay, contactless credit and debit cards, and other digital wallets through a simple tap to their iPhone. No additional hardware or payment terminal needed. For now, at least, it looks like they're doing this alongside the behemoths of the financial world. This system still primarily relies on other banks issuing cards to their consumers and then routes transactions through networks like Visa and MasterCard. However, Apple is moving in a direction to seemingly cut them out of this loop too, and create a so-called closed circuit for payments. Rather than adding a Visa debit card from HSBC to your Apple Wallet and then using that to send money in a transaction processed by Visa, instead, it might be the case that all of this money is kept in an Apple Cash account, sent to another Apple Cash account using solely Apple's system. And this is ultimately the crux of the matter here. Whether Apple actively wants to be a bank is still up for debate. But what they've consistently done throughout their recent history is beef up and lock down their ecosystem. And you'll recognize this if you own basically any Apple device. That's because Apple pushes you to buy more stuff or services from them to get the full experience or to stay trapped in their ecosystem, depending on how you look at it. This could be things that Apple de facto require, like an iCloud subscription or Lightning connector, through to other things like iMessage or the purchase of companion products like AirPods or the Apple Watch, both of which are only fully featured when paired with, you guessed it, an iPhone. Now, this strategy is often termed as Apple's walled garden. Once you're in the ecosystem, it becomes harder and harder to leave. And that's where one of the biggest issues begins to arise to any banking aspirations for Apple: competition. Or more specifically, competition regulation. Big tech as a whole is currently facing a lot of scrutiny from competition regulators in the US, UK, and EU, be it due to proprietary charging cables, looking at you Lightning, through to the high fees on App Store purchases. Now, we all know the power that companies like Apple, Alphabet, and Meta have on the core aspects of our lives already. But now imagine if, or maybe more likely when, they properly enter the financial sphere too. In fact, regulators are already keeping a close eye on big tech's foray into finance. Back in October, the UK's finance regulator, the Financial Conduct Authority, announced an inquiry into whether Apple, Amazon, Alphabet, and Meta's growing interest in retail financial services might be used to exploit their ecosystems and lock consumers in. And they're not alone either. The European Commission has also opened a probe into Apple's dominant position in the mobile wallet market, i.e. Apple Pay. Now, if Apple were to launch a full-throated move into the banking sector, this would put them at risk of landing firmly in the sights of not only competition regulators, but financial regulators too. And this could end up putting them off. It's just not clear whether Apple wants to take such a big risk at a turbulent time for both tech and banking. This whole dynamic, the debate, the arguments, the regulation, only goes to prove what a difficult and complex time we live in right now, both politically and economically, as both sides end up butting heads more than ever. So it would be great if politicians were better at, well, maths and decision making. Fortunately, they could do that easily if they signed up to Brilliant, the STEM learning platform where you can learn everything from quantum computing or algebra to logical decision making, a skill severely lacking at the moment. It doesn't take long to learn either. These complex topics are broken down into accessible chunks, designed around your busy schedule. That means that by spending just a few minutes each and every day, you can accumulate new knowledge over time in an actually fun way. And as time goes on, you'll get used to that empowering feeling of learning. Because this isn't just about memorization and lectures. Brilliant teaches you by doing, using active learning techniques to teach you the principles behind otherwise complex subjects, and ensuring that you actually understand what's going on. So whether you want to brush up on your basic math skills, improve your employment prospects by learning about future technologies, or just have fun with coding, you can check out everything that Brilliant has to offer for free for a full 30 days just by clicking the link in the description. Plus, the first 200 of you will get 20% off Brilliant's annual premium subscription.